Picture two people. One has an 820 credit score and $4,000 in the bank. Sounds impressive, right? The other has a 620 score and $80,000 sitting there. Who's actually winning this game? Here's the thing. The score you're bragging about might actually be measuring the wrong game entirely, friend. That 820 person feels like a winner. Mailers arrive, pre-approvals stack up. Little arrows point up on their app. Meanwhile, the 620 person looks reckless on paper, but has real money sitting in a real bank account. When the car breaks down suddenly, guess who actually sleeps through the night without panic or any worry? Most people don't realize the score isn't a wealth report. It's a report card graded by lenders. Banks literally cheer when your number climbs higher. Not because you're winning the game, because they are winning.
Let me explain the hidden mechanic nobody bothered to put in your high school financial literacy curriculum. Let's start with the myth. Someone told you the credit score equals your financial health. Teacher, parent, influencer. The story goes, keep that number high and life gets cheaper. Rent easier, mortgages sweeter, you become responsible. But here's the truth. FICO wasn't built to measure how healthy you actually are with your money at all. It was built in 1956 by Fair, Isaac and Company to help lenders decide who to lend to. That's the whole origin story. It's a tool for banks, using your behavior as raw material to score you. Somewhere along the way, we consumers got convinced this was our grade, our identity, our badge of honor. Here's what nobody tells you. 4 of the 5 things your score measures reward one thing, being in debt. Not being wealthy, in debt. Watch. Payment history is fine, pay your bills. But then look at the rest.
Amounts owed, length of credit history, new credit and credit mix. Translation: how much you owe right now, how long you've owed it, whether you're shopping for more, whether you've collected different debt types like Pokemon cards. The system doesn't even know you exist unless someone is actively collecting interest from you every single month. Your parents repeat the rule because their parents did. Your school repeats it because a bank sponsored the pamphlet. The average person confuses a high score with financial success, just like people confuse being busy with being productive. Then a paradox blows the whole story wide open. Here's the paradox, and you might recognize both types. There's a real American who paid off his house, drives a used car, keeps 6 figures in index funds. Yet his credit score sits in the low 600s, sometimes officially labeled, quoting the industry directly here, poor.
Meanwhile, a broke 28-year-old has 3 credit cards, a car loan, a personal loan, and a store card. He rents his apartment and he can be sitting at 810. He owes everyone. He owns nothing. The algorithm calls him elite. Why? Because utilization, one of the biggest score inputs, rewards you for carrying balances.
Length of history rewards you for never closing a line. Credit mix rewards you for stacking loan types. The number isn't measuring your wealth at all. It's measuring your profitability to the lender, plain and simple. It's the grade banks give you as a customer, not the grade life gives you as a real saver. The wildest stat: households with the highest scores also carry some of the highest total debt loads nationwide. Not because they're careless, because the game literally requires it. Here's the mechanism nobody explains out loud. Let's break down the mechanism piece by piece. First, credit mix, the factor rewarding you for variety. To max this out, you're gently encouraged to hold installment loans, revolving loans, and maybe a mortgage. So the system whispers, take a car loan you didn't need, finance the couch, open the store card. Every new debt product becomes another line item improving your file. Second, length of history matters heavily. This rewards you for never closing accounts. That ancient card with the $99 annual fee stays open. The one you don't use? Closing it drops your score. So you keep it, you pay the fee. Year after year, just to protect the number. Third, new inquiries hurt whenever you try to shop around. Want a better auto loan or refinance your mortgage? Every hard pull dings you. So people stop shopping. They accept the first offer, which is exactly what the lender wants. Fourth, and this is sneaky, the psychology. Modern banking apps have turned your score into a slot machine with colorful arrows and confetti. Push notifications celebrate. Your score went up 7 points. That's a dopamine loop gamifying you into fee-generating behaviors. Fifth, the fees themselves. Annual fees, interest, late fees, balance transfer fees, cash advance fees, foreign transaction fees. On the merchant side, swipe fees are baked into the price of everything you buy at every store.
Every point of loyalty to this system is a small transfer from your pocket to somebody's quarterly earnings. The bank doesn't love you back. It loves the reliability of your monthly payment. Smart money flips this. Here's the reframe that changes everything. Stop reading the score as a measure of you. Read it as leverage. It's a measure of how attractive you are to lenders. That's it. That's the whole thing, nothing more. It's just a borrower reliability grade. Real wealth is different. It's the gap between what you own and owe. Real wealth is the number of months you could survive with zero income. Real wealth is boring. It doesn't ping your phone. It doesn't come with a color-coded meter. And here's the punchline most people miss. Cash buyers who pay for their car outright, own their home outright, carry no balances, invisible to the algorithm.
Not because they failed, because they graduated. They stopped being useful raw material for the lending machine. Ever wonder why lenders bombard people in the 70s-80s with pre-approved offers? Not because they're safest. It's because they're the perfect sweet spot, high enough to qualify, human enough to occasionally carry a balance.
Aspirational enough to say yes to a bigger limit. That mailbox stack isn't a reward, it's a fishing net. The hidden cost of chasing 850 isn't just the interest. It's the mental bandwidth you burn tracking it. It's the years you spent optimizing a number instead of building an asset. Watch what 20 years actually costs. Meet score chaser Sam. He's 30 and his single life goal is one perfect number, an 850 credit score. Sam carries 5 credit cards, always keeping a small balance because someone online swore it helps his score climb. He refinances his car loan every 3 years to keep the credit mix looking fresh and nicely diverse. He upgrades his phone on a payment plan because that installment history apparently builds his precious score even higher. On average, Sam pays about $300 every month in interest across all these clever little products. Now meet wealth builder Wendy, also 30. She owns 1 credit card, uses it for groceries, pays it off monthly. She drives a used car she owns outright. Her score sits around 740. She never optimizes anything. Instead, every month, she takes that same $300 and drops it into a low-cost index fund. Now, do the math with me. $300 monthly, compounded at 8% annually, over 20 full years. That comes out to roughly $176,000, almost $180,000 real dollars. Sam paid that to the banks. Wendy paid that to her future self. Same income, same age, same start. One number was different. What they optimize for. Here's where people always push back on me hard. But Andy, what about the rewards? The 2% cashback? The airline miles? Okay, let's be honest. The average rewards card returns roughly 1.5 to 2% back to you, the cardholder. The average interest rate on a carried balance sits somewhere around a brutal 22% per year. Carry a balance 1 month a year, and interest wipes out the rewards for the entire year, plus some. Rewards only work for people who pay in full every month and treat the card like a debit card. That is a small minority. The majority are quietly subsidizing the minority every single month of the year. The car companies are laughing all the way to to themselves. They are the bank. Here's another compounding effect most people miss entirely. Lifestyle creep tied directly to your credit limits going up. When your score climbs, your limits climb, and your brain quietly recalibrates what feels normal to spend. Suddenly, you use 20% of 30,000 instead of 5,000. Same ratio, 6 times the actual debt.
You didn't get richer, you got permission to spend more. And the climax number is bigger than most expect. The average American pays somewhere between $6,000 and $8,000 in avoidable credit card interest over a lifetime. That's not including car loans, annual fees, or the interest portion of a mortgage stretched an extra decade. That's not including the opportunity cost, the money that never got invested and never compounded for you. Stack it together, and the true price of playing the score game hard runs into 6 figures per household. Meanwhile, they'll proudly tell you their score is 810, and they'll believe that number saved them money. Here's a specific example. High-score households qualify for larger mortgages, often meaning bigger houses, even at lower rates. Bigger houses mean bigger property taxes, bigger insurance premiums, bigger utility bills, and bigger maintenance costs every month. Plus, more square footage to fill with stuff, often bought on, you guessed it, more credit cards. The score didn't just get them a good rate, it quietly enrolled them in an entirely different lifestyle. And that lifestyle costs more than the interest savings ever returned. The math never actually works out.
So the responsible score person ends up with more house, more stuff, and less net worth than the average. The score didn't save them, it sold them a bigger trap. So what should you actually optimize instead? Here's the framework. 3 rules. Write them down if driving. Actually, don't write while driving, but remember them. Rule 1. Use credit, don't chase it. Have a card, pay it in full, move on. Simple. Rule 2. Don't feed the algorithm. Stop opening accounts to chase a number. Stop refinancing to refresh your mix. Stop applying for store cards at the register because the cashier offered 10% off a pair of pants. Rule 3. Don't measure yourself by the wrong metric. Your net worth is the metric. Your savings rate matters. Your months of runway is the metric too. The FICO number is a byproduct, not a real goal. So, what's the actual target? Here's the thing most people miss. Aim for 740. That's it. Above that, mortgage rates barely move. Insurance rates barely move.
Landlords barely notice the difference at all. Every point past 740 is bandwidth stolen from something that actually builds real wealth. Stop white-knuckling every point. Close useless cards on your schedule, not the algorithms. Yes, closing an old card can dip your score. If you're not applying for a mortgage in the next year, who cares? The dip is purely cosmetic. The annual fee you're dodging is real money. And here's the rule that quietly changes everything for you. Borrow only for things that appreciate or produce income. That's a short list. A home you'll actually live in, education with a clear payoff, a business with a real plan. That's basically the entire list. That's it. Everything else, the car, the couch, the vacation, the phone, the wedding, that's lifestyle spending, not investing. Financing, it means you paid more for the same thing and rented the difference from a total stranger. Remember the phrase, real wealth versus looking wealthy. The whole credit industry is built around the second one. It rewards the appearance of financial competence while quietly extracting the actual substance of it from you. The person with the 820 score and the empty checking account looks like they clearly won. They lost. Slowly, one autopay at a time. That's the hidden cost of chasing the wrong number for years. Set up a monthly 15-minute money check-in. Not an hour, not a spreadsheet marathon, just 15 focused minutes. Look at 3 numbers: what you own, what you owe, and the difference. That difference is your net worth. Track it monthly the way you used to track your score and watch your attention reorganize around what matters. Because attention is the whole game. Whatever number you watch, you slowly optimize your entire life around it. Watch the FICO, you optimize for the bank. Watch net worth, you finally start optimizing for yourself. Here's the thing, This whole score conversation connects to a bigger trap I want to break down next: the rewards card paradox. The idea you can outspend your way to wealth by racking up points and miles. It's the same illusion in a shinier wrapper. It works for a tiny sliver of truly disciplined players, and it quietly bleeds everyone else dry. One swipe, one statement, one carefully marketed reward at a time. If you liked how we untangled the score today, that rewards episode will really flip your entire worldview. It also ties into the episode I did on the myth of good debt. Debts secretly disguised as investments. Spoiler, most of them aren't investments. Most of them are just plain debts wearing much better marketing. Zoom out with me. Here's the reframed definition of wealth I want you to walk away with today. Wealth isn't what shows up on a score. It's not what shows up in your car or feed. Wealth is what shows up in your account when nothing else is happening. It's the quiet number, the boring number, the one that grows while you sleep because you stopped funding somebody else's growth quietly. When you flip that switch, stop optimizing the borrower grade and start optimizing the owner grade, everything changes. Your stress goes down, your options go up, your future self gets richer without you hustling harder. That's the whole smarter money worldview. Before you go, one small ask from me that really helps here. If any of this reframed how you think about your score, do me a favor and subscribe now. Every week I break down one thing about your finances that the industry would rather you never see. One hidden mechanism, one flipped assumption, one calmer decision you can make with clearer eyes every single week. Next episode, we'll pull apart the rewards card paradox and show when points are bonus versus bait. If you want to keep making smarter money moves, come along.